and welcome to the third and final installment of Andersen's budget webinar series. I'm Joanne Haig, Managing Director of Prison Chambers in Mauritius, and I'll be moderating today's session. So today we will be discussing some of the measures introduced by the Finance Miscellaneous Provisions Act 2021, which entered into force last week on the 5th of August. You will recall from this year's budget, earlier this year, that this budget was tagged as being a no-tax budget. And I think that wasn't an inaccurate label, in so much as there were no increases in income tax, solidarity levy, VAT, and some of the rumors that have been circulating before the budget around the introduction of a wealth tax possibly turned out to be fake news, to the great relief of many of us. On the other hand, there were some indication that there was support in terms of tax incentives. So there was an extension of the partial exemption regime, a further extension, the introduction of certain reduced rate of tax for certain targeted sectors, such as in the pharma sector, and also extension of tax holidays for other sectors, such as family offices and asset management industry. And of course, as is the case every year, there were still a few surprises that came out in the finance bill, and we will be discussing some of these measures in more detail in today's session. I am joined by a rather excellent panel of distinguished guest speakers, which I will now introduce. To my right, we have Mr. Gordon Stewart.
Hello, Joanne.
Hi, Gordon, from Accuro Mauritius. Gordon, you're an expert in private client and fiduciary and trust business. You've spent a long time in South Africa and more recently in Mauritius. We're very privileged to have you here today. Welcome.
Well, thank you so much for the invitation.
Thank you. Next to Gordon, we have Mr. Mauritius Anlas, who I don't think you need any introduction, but I'll say a few words anyway, Mauritius. So Mauritius, you're now a technical advisor to the Director General of the Mauritius Revenue Authority. Prior to that, you were director at the Large Taxpayers Department for quite a long time. And I think it's fair to say that you have a huge role in where Mauritius is today in terms of OECD compliance and making sure we are on the white list in terms of tax.
Thank you, Joanne.
Welcome.
I'm very pleased to be on this panel.
Thank you. And last but certainly not least, Mr. Fazil Soifu, who's a partner at Andersen in Mauritius. For those of you who have been watching the two previous webinar series, you remember Fazil as the moderator. You're now in the hot seat today, Fazil. So I'll be asking you some tough technical questions.
Looking forward to it, John. Thanks for having me.
Thank you. And so Fazil is a tax specialist, and you have a wealth of experience in cross-border taxation, international tax, and tax structuring. So a very warm welcome to you all.
Thank you.
So before we start today's session, a couple of housekeeping rules. The webinar is planned for about 90 minutes, and we will have a panel discussion on 3 or 4 big themes first, which will be followed by a Q&A session. So most of you should have a Q&A tag or a chat box at the bottom of your screen. Please feel free to pop in your questions as we go along. We will try to tackle as many of them as possible at the end of this session. So without waiting any further, I'll kickstart today's session. I think the first theme that I want to talk about is perhaps what came as a bit of a surprise to everyone. And the reason why it came as a surprise is that it wasn't announced in the budget speech. So when it first came out in the finance bill, practitioners and the industry at large were quite shocked, to be honest. It's the abolition of the declaration of non-residents for trusts and foundations. So for most of you will be aware that where trusts and foundations had settlers and founders and beneficiaries which were not resident in Mauritius, they had the option of filing a yearly declaration of non-tax residence, which effectively had the result of making the trust exempt. This is now gone. There is a limited grandfathering for existing structures up until the year of assessment 2024-2025, but for new structures, this is now gone. So obviously, big change, unexpected change. So Mauritius, I'd like to start with you. What is the background to all of this? What is the context of these changes?
Yeah, thank you for this question, Joanne. And you give me the opportunity to explain the rationale. And I think you mentioned that it came as a surprise. In fact, it was announced in the budget by the minister that there will be some reviews in terms of making sure that the regime complied with the substantial activities requirements. It was mentioned if you go to the budget. But what probably people didn't know that of the abolition of that declaration of non-residence, and which will have the, in fact, the effect that they may become taxable. Now, it's a good question because you all know that in 2017, all our preferential regime were reviewed by the OECD and subsequently by the EU. And at that time, the OECD were more focused on the GBC1 and GBC2. They were particularly interested in this harmful features, the deemed foreign tax credit. So they omitted or they did not pay attention to trust and foundation. And we had so many things to do that we knew that there were certain things that should be looked into in the regime of trust and foundation. So what happened is that just before the budget, we received a correspondence from the OECD Secretariat telling us that there are some harmful features in the regime for foundation. And as the regime for trust is more or less similar, we knew that this will be coming, and they even said that this will be on the agenda, the next forum of harmful tax practices. So we were very worried that, the thing is, Mauritius is in the white list in terms of taxation for OECD and EU, and things may change just because if we have some harmful features, they may review the position. So I think it was a good move to make it make sure that our regime comply with the international standard. Of course, there has been some representations made by the stakeholders that Mauritius may not be competitive in terms for these regime of trust and foundations. But I think the issue is that we in Mauritius, we treat trust and foundation as in a similar manner as company. And there has been discussion with the stakeholders, and we are in the process of preparing issuing the MRA will shortly issue a statement of practice so that we can see. This will be probably an interim solution because we have to, in fact, when you look at the law, section 73, you see the definition of trust and foundation. But when you look at the definition of what is a resident company, you go to section 73A, which says that a company which is incorporated or registered in Mauritius, and has its central management and control outside Mauritius, and if that company can demonstrate central management and control outside Mauritius, they will be treated as non-resident company. And as non-resident entity, they will be taxed only if they have Mauritian source income. I don't know if I've answered your question, but it was very important that we, Mauritius, we have committed to adhere to international standard, and we should see to it that all our tax regimes are fully compliant with the international norms and standards.
Thank you, Mario. I think it does answer my question, and we're hoping that the statement of practice will go a long way in mitigating some of the effects. Gordon, if I may ask you now, from an industry perspective, notwithstanding what Mario has just said in terms of the statement of practice, what do you think is the likely impact on the fiduciary business in Mauritius?
Thank you, Joanne. Look, I've got to say that I cannot see how this will not adversely affect the fiduciary industry in Mauritius. And I'd like to just quote from the minister's speech. So where he said, I now come to the financial services sector, which is one of the few sectors which has registered positive growth in 2020. The strategy for the financial services sector is twofold. First, to enhance the status of our financial center as a jurisdiction of the highest global standards. And I think that ties in with what Mario has just said now. And then second, to continue to improve and deepen the service offering of our financial center. So owing to the fact that trusts are, and when I talk about trusts, I talk about foundations as well, but so owing to the fact that trusts are typically the cornerstone of most private client and family office structures, taxing them is going to have the complete opposite effect to deepening the service offering of the Mauritius Financial Center. You know, if the tax rates, and again, I hear what Mario has said, but if the tax rates for trusts and foundations are not competitive against other jurisdictions, then clients will simply move the administration to another IFC. Why would a client choose Mauritius and pay tax at 15% when he can go to the BVI, Cayman, Guernsey, Jersey, Isle of Man, Dubai, Seychelles, amongst a whole lot of others, and pay zero tax? And I think we need to understand that clients are not beholden to Mauritius, and the administration can be done from any jurisdiction. So I'm glad to hear that Mario has mentioned that there's a SOP coming out, because unless this is rectified immediately, it's going to result in no or few to no new trusts being established, and there will be a steady migration of existing trusts to other jurisdictions. You know, the loss of the new business and the migration of existing business to is going to have consequences for the country. So, you know, just from a scenario, I foresee the following scenarios taking place is that, you know, whilst the multinational MCs can adjust to this, and they can, for example, appoint a majority of trustees outside of Mauritius, it's going to materially affect the management companies that only have a local representation in Mauritius. What do they do? How do they deal with this? There's going to be less need for Mauritius companies because the two are often connected. You know, with a reduction in trusts and companies under management, the likelihood is that less people are going to be recruited into the sector. And there is also the possibility that people could be retrenched. You know, I see that there's perhaps there'll be an impact on the support industries like the accountants and the attorneys, because there will be less need for their services. And all of the above is going to result in a reduction in regulatory fees and tax revenue for the country. You know, one other point that I just picked up from, you know, from the Finance Act is, you know, as trusts and foundations are essential to family offices, I don't understand the logic why they want to tax trusts and foundations at 15%, but yet they are offering a 10-year tax holiday to family offices. You know, that's sending, you know, mixed messages, and the market is looking for certainty. So the worst case scenario is that the trust and foundation industry will all but disappear. Best case scenario is that Mauritius will become really nothing more than simply a back office for global shared services. So, you know, in conclusion to your question, I've got to say that based on the feedback that I've received from as far afield as the US, South Africa, clients in the UK and other jurisdictions, you know, this change has adversely affected Mauritius's reputation, which has already been tarnished by our EU blacklisting. So yeah, I don't believe I understand the logic, Mario, I really do, but I think it is going to have material consequences unless, you know, the SOP can rectify that.
Johan, just because Gordon has painted a rather pessimistic picture, but I think that we should be optimistic. You know, the problem is that we have always tried to Mauritius comply with all the standards. At the same time, we are very concerned about the level playing field. And we know that there is an issue in terms of, in certain jurisdictions, they consider trust and foundation as transparent entity. And so they don't have this problem which has been raised. So we have seen that even in our law, it will be an interim solution until we fix it, but there is a solution, which is in the section 73 and 73A. We will have the opportunity to discuss further on this.
Great.
Thank you. That's encouraging, Mario. And I think I'll use the comments that you both made to now turn to Fazil, because I think it's interesting you use the word interim solution and short-term solution, but I think we should also obviously be looking at the longer-term picture. As you said, Mario, our competitor jurisdictions don't seem to have the same problem for different reasons. So the Channel Islands, you look at even Singapore trusts, they have a different way of treating trusts and perhaps foundations as well, and they don't seem to have the same issues with the OECD. Is it perhaps time to overhaul our trust, the tax treatment of trust and foundation in Mauritius?
Thank you, John. I think it certainly is. I think I hear what Mario is saying with regard to the context in which we are operating, and I hear also what Gordon is saying from a commercial perspective in terms of the implications. And the fact of the matter is, if the rules stay as they are, they will have a damaging impact on the trust and the business here in Mauritius. But we're hopeful on what the statement of practice will contain, as said by Mario. But there are some additional complications that I feel when it comes to assessing how the trust shall compute their taxes and to what extent they can benefit from the exemptions or the incentives that are present under our tax legislation. You know, as you stated, trusts and foundations, I'll mention trusts, but the same analysis can be applied to foundations, are treated as companies under the Income Tax Act. So in terms of the test of residence for a trust as it stands today, it's one or two circumstances. So either the trust is administered in Mauritius and a majority of the trustees are in Mauritius, or the settlor is resident in Mauritius at the time the instrument creating the trust is executed. Now, when we look at the global business sector, most trusts that we have are administered in Mauritius, typically by a single trustee, being the management company. So they'll automatically become resident in Mauritius if they cannot submit a declaration of non-residence. So as a result, they will be subject to tax just like normal companies. So to the extent they've got chargeable income, they will have to compute their taxes. So to the extent that they have income that falls within the partial exemption regime, which we'll talk about later on the webinar, then could they benefit from the partial exemption regime? How do they meet the substance requirements? The substance requirements have been drafted for companies. Can we apply them for the trusts? How do the trusts, for example, demonstrate co-income generating activities or MD employment criteria? So these are all practical considerations that we need to be aware of. But above and beyond that, the fact of the matter is that the changes do put Mauritius at a disadvantage, but we remain very hopeful, and we yet to see the statement of practice. You talked about the Channel Islands and Singapore, and let me comment to that. I think the key with regard to trust, unlike GBC companies, GBC companies coming here, beyond the fiscal attractiveness, there are other factors that incentivize them. You know, the ease of doing business, the resources available here, the stability. But trust, even though from a tax perspective are treated like companies, in reality, the commercial reality for trust is very different. As Gordon was saying, the trust can be administered from anywhere. And then even yesterday, I was speaking to someone who was considering setting up a trust in Jersey as opposed to in Mauritius. Looking at the rules as they are today in places like Jersey and Guernsey, the trusts there are exempt from foreign source income, so income that they receive from outside the jurisdiction, and they're also exempt from interest income arising from within the jurisdiction on bank deposits. By contrast, a trust that will be resident in Mauritius with a bank account in Mauritius will potentially be subject to tax on the interest income derived from that bank account in Mauritius. And the beneficiaries will be typically a tax on the distribution from the trust. So suddenly you have double taxation at the level of the trust and at the level of the beneficiaries. If we look at, let's say, Singapore, you've got the qualifying foreign trust regime, where again, if the settlors and the beneficiaries are outside of Singapore and the trust is administered from within Singapore, then largely the passive income is exempt at the level of the trust. So to pick up on Mario's point is, yes, we want a level playing field, but at the moment, it doesn't feel that we have quite a level playing field. If our competitor jurisdictions can have a system whereby they have a more attractive fiscal regime for trust and foundations, and we cannot. So the way I say, John, you asked me about revamping of the system. Yeah, maybe it's time to look at the system holistically. And the way I say, there are two options. So either we look at the test of residence. We say that trust and foundations are carved out of the definition of residence through central management and control, through administration or otherwise. Or we have an exemption regime which exempts the foreign source income or the foreign income received by the trust and foundations, as well as income from other GBCs. So time will tell. The statement of practice will, I don't know when it will come out. Maybe Mario can give us some further color on that. But if it doesn't, and if we don't address the system properly, as Gordon says, we will lose that business.
So I think we have heard both positive and you know, mixed messages, but I am still hopeful for the future. So we'll fingers crossed for the SOP, but I think it is important to look beyond as well. On a slightly more positive note, let's look at some of the tax incentives that were introduced this year. If I may start with the partial exemption, the extension of the partial exemption regime. Now, the end of the grandfathering period was at the end of June 2021. So in a way, the partial exemption regime is now fully operational. So I think a lot of questions that we get asked as practitioners very often from our clients is, in practice, how is the MRA monitoring the substance requirements for the PER?
Good question. You know, Joan, let me, before answering directly what is being done at the level of the MRA, maybe I should mention that in terms of monitoring of substance, this is done, in fact, there are two layers. We start with the FSC first, because when we look at those companies, holders of global business license, the monitoring is done by the FSC initially. They will assess compliance through, I think there's a declaration which has to be made annually by a global business company, and they submit it together with their financial statement. So those GBC that avail themselves partial exemption regime, they will be, in fact, review their compliance with SIGA, with the core income generating activities, with substantial activities requirements will be reviewed, will be monitored by FSC. And there is also, in parallel, the management company, they have to also submit a declaration whereby they will tell for which GBC companies they have, let's say, their services have been retained to carry out the SIGA, the core income generating activities, because I think there is a requirement for us to ensure that there is no double or multiple counting. And then if there is something which they're non-compliant, the FSC will report this to the MRA. But the second layer of control, which your question is, it's at the level of the MRA, because we have tax here, we have a tax system. We are not like the countries where there's no tax being imposed. In other countries, if you don't comply, they will remove your license. But here in Mauritius, if for non-compliant, you will just be taxed at the normal rate of 15%. So at the level of the MRA, what we have done, we have redesigned the income tax return, as you are aware. The GBC companies, when they fill in their return, they have to give a lot of information about whether they are fulfilling the conditions, substance, about their nature of the activities and so on. So the information being received are cross-checked with our, because we have in our database a lot of information, being even that the MRA is not only looking for corporation income tax, but we also look at pay as you earn, we look at pension contributions, so we cross-check. So then the inspectors, they do, if, for example, you talk about the partial exemption regime, which is being claimed by a lot of companies, not only GBC companies, but also non-GBC companies. So they will do a selection based on a risk-based analysis, and they will select those cases where necessitate a tax audit. And if ever these companies do not comply with the substance requirement, obviously actions will be taken in terms of denying them the partial exemption. They will be taxed at the normal rate.
Thank you. It's been very useful to hear about how in practice it will work. Fazia, I want to ask you about, so extension of partial exemption regime, reduced rate for certain targeted sectors, extended tax holidays. What has been your experience in terms of, do you think that all of this will be sufficient to retain GBCs in Mauritius and to attract new investment in Mauritius?
Thank you, Joanne. My experience is that we used to have a tax system for GBCs that, in my view, had three main attractive features. There was a low tax rate of 3%. It was simple to administer. And there was a fair degree of certainty for the investors in terms of what they could expect without a taxable position and a tax liability, actually. Now we have a tax rate of 15%, which represents a whopping 400% increase. And trust me, many companies that are in that bracket, they're feeling the pain. Then we have a system whereby a company can have income that's subject to anywhere from 0% to 3% flat, to 3% with conditions, to 15%, all within the same entity. And there's a lot more subjectivity in the rules. I mean, one needs to look at the latest statement of practice on partial income exemption as it relates to interest, and you'll know what I'm talking about. Now, admittedly, there are well-documented reasons as to why we had to abolish the effective 3% rate, and I won't go into these. And let's give credit to the authorities for coming up with systems such as the partial exemption regime and the tax holidays to sort of soften the blow of the abolition of the previous regimes. However, these solutions are not enough. They're not sufficient. And the most obvious thing being that they are only applicable to certain limited types of income. As far as the finance tax is concerned, I think it's encouraging to see the partial exemption regime being extended to more types of income, to see new tax holidays being introduced. I'm glad for the companies that fall within the list. In fact, I myself had an experience where one of my clients was very disappointed with the 15% rate and they were threatening to leave the jurisdiction. I'm talking about a client with a full-fledged office here, with C-level execs here, and through representations, we managed to get their income within the partial exemption regime and the estate. But these stories are few and far between. And when it comes to tax holidays, they are good incentives, but they need to be for long enough periods to give investors that comfort that they can come here and plan ahead for their business and plan for their longer term presence in Mauritius. And it's great to see the extension for family office holidays going from 5 to 10 years, the extension for 5 to 10 years, albeit the context raises more questions than solutions. The thing we've got some 5-year holidays, for example, which for me is way too short. You have a company that can be making losses in the first few years. Then by the time they start generating profits, they've got the losses carried forward to utilize. And by the time they can start enjoying the tax holiday, the holiday is over, or there's only 1 or 2 years left. So if you ask me, are these incentives sufficient to keep the GBCs in Mauritius? One way to look at it is just to see how many GBCs remain past the 30th of June conversion deadline with the expiry of the previous grandfathering regime. I don't have the numbers, but from experience, we've seen many GBC ones choosing not to convert to GBCs and instead converting to authorized companies or migrating altogether to outside Mauritius. Now, I agree with the argument that many businesses come to Mauritius for non-tax reasons, the ecosystem, etc. But the fact of the matter is that many businesses choose Mauritius because of the fiscal attractiveness. Let's not shy away from saying it. So at the end of the day, what is needed? In my view, rather than a couple of additions here and there, every budget, now we've seen it for the past 2-3 years now. So there's a bunch of representations made, and then at the end of it, it's limited to 2 or 3 additions to the partial exemption regime and to the tax holidays list in the budget. Maybe narrowed down further when it comes to the Finance Bill and the Finance Act. I think we need a more holistic review of the fiscal attractiveness of the jurisdiction, a bit like we talked about for trusts, but even wider. Let's make no mistake, we are operating in a very difficult environment. The scourge of the blacklist, Gordon, you mentioned it. Our jurisdictions being very competitive, the MLI, you name it. There's so many pressures out there. What I would like to see, and then let me finish on that, is a well thought through, calculated, proactive approach to how we can enhance the fiscal landscape in Mauritius. And I think we've got ample time between now and next year's budget for the policymakers to sit down with all stakeholders and to look at within the framework that you're operating, and bearing in mind the pressures that we have, and as Marion said, come up with a solution that that sets the path for us for the next 5 or 10 years for the industry. At the end of it, we should come up with a system that is simpler, that is less subjective, and maybe with a lower tax rate, but maybe that's wishful thinking. So for me, that would be a lot more impactful than a series of small piecemeal measures here and there.
Yes, I fully agree, and I hear you. I think it is a double-edged sword, because if it's simpler, then it's less work for us. But we'll think about the greater good. Yes, I think there have been ad hoc, plaster upon plaster changes over the last few years, and a meaningful overhaul, I think, would be more beneficial in the long term. I fully agree with you on that. I want to talk, Gordon, about a measure that was introduced last year, and the tax treatment has now been clarified in respect to it. And I think that is a positive measure. To what extent it will have a bigger effect on the economy is another discussion. The premium visa. So the tax treatment has now been clarified. If you don't remit money in Mauritius, or if you deposit money in a bank account and you prove that you've paid tax elsewhere, you won't be taxed in Mauritius. Since the introduction of the premium visa, what is the interest that you've seen in that visa based on your client base?
Yeah, I think first of all, well done to the MRA on actually giving that clarity, because when it first came out, there was a lot of confusion, and people were, very concerned as to whether they would be paying tax in Mauritius and as well as in their country of residence. So, even though I've done 3 webinars very recently on Mauritius, I've unfortunately not had any queries. I was hoping I could say a few, but I haven't had any queries from delegates or even from my clients or business introducers. So whilst I personally believe that the concept is great, and I have to congratulate the EDB for coming up with this idea, I think there might be a number of factors that are causing perhaps a lack of interest in it. I think we've got to start off with a guilty one, and that's got to be COVID. I mean, COVID has obviously had a major impact on people's ability to travel. I speak from a South African perspective, because that's obviously my background, and that's where the majority of my clients come from. And, South Africa has obviously gone through quite a lot of turmoil recently with their COVID numbers, and they've also had travel restrictions in addition to the travel restrictions that Mauritius has had. So I think COVID has to be first on the list. Then second of all, I'd be curious to see who is the target market of this premium visa, because of its short-term nature. I mean, we're talking about a year. Anyone who has got school-going children is probably not going to be able to use it. You're not going to take your kids out of school for 1 year, try and get them a place in a school in Mauritius, and then take them back out again. Then I think, second of all, anyone who actually physically needs to sit in their country of residence in order to be able to do their job, that person's also going to be excluded. And then I was thinking about it and I thought, you know, even someone with pets is probably not going to be able to use it because, you know, you've got the issues of quarantine, bringing your pets across. It's expensive to move an animal from, say, for example, South Africa to Mauritius. So I think this really leaves us with a much smaller demographic of people who can actually make use of this premium visa. Then there's a number of logistical issues that are facing this much smaller number of people who can make use of the premium visa. You've got the cost of the relocation to Mauritius. You know, we've got to take into account flights. When you arrive here, you've got to find a property. You've got to pay deposit. I mean, typically it's 2 months deposit that you have to put down. And then because of the high import tariffs for motor vehicles, you can't bring your car across. It's not financially viable. So you're going to have to come across here and rent a motor vehicle, in which case then you're going to have to put down deposits, etc. Then you've got the cost of living in Mauritius. I mean, you know, we can't overlook the fact that Mauritius is a high-cost jurisdiction for expats. Property rentals are high. The cost of motor vehicles are high. And then you've got just your basic costs of maintaining a household. So as most premium, because of the short-term nature, because most premium visa holders are still going to retain, for example, maybe their property or their assets, etc., and the expenses back in South Africa, you've now got double costs. You've got your costs in Mauritius and you've got your costs back in your home country. And then there's the soft factors, you know, there's the psychological issues. So, you know, you're moving out of a country for a short period of time. You're leaving your support structures. You have to make new friends. You know, you've got to find a doctor. You've got to find a dentist. You know, you've got all of these kind of soft factors that are brought in. Then tax. And yes, it's great that the MRA has given us clarity that you won't really have to pay tax unless you bring the funds into Mauritius. Or if it's paid into your bank account in Mauritius. But remember that if you look at someone like a South African, surely they, as taxed under their global source income, they're not going to get really much of an exemption. So they're still going to have to pay tax in South Africa. So then it really boils down to your disposable income, because can you afford, after your disposable income, to incur the costs of living in Mauritius and still incur the costs of your assets back in South Africa? And then I was just thinking, you know, taking into account all of the inconvenience of all of those, is it worth it just for 1 year?
I think that it's interesting that you put it that way. I've got clients, what they've done is that they've come here and done the premium visa initially for 1 year, but with the intention of seeing whether Mauritius could be a place to settle longer term. And we'll come back to that later about the longer term picture. But Mario, I had a technical question for you. So I think from a personal income tax perspective, great, no tax in Mauritius, perfect. But if we're seeking to attract people who are potentially employed elsewhere, so they're working for a foreign company, but they're going to be based in Mauritius for a year, are other normal tax principles going to apply? So I'll give you an example. Will that person create a risk of a permanent establishment of that foreign company in Mauritius by sitting here and working in Mauritius for a year?
And just, I understand, I don't know if I'm mistaken, they have a premium visa for 1 year and then they have the possibility to renew.
That's correct. That's correct.
Coming back to your question, Joan, you know, the law, in fact, how we have made it is a sort of a derogation for those holders of premium visa. They will not be taxed like others, because for individual, what we do, the normal rule, if you are resident in Mauritius, you pay tax on your Mauritian source income and foreign source income to the extent that on a remittance basis. But for them, we've said that even if they will be working in Mauritius, and they will not be, because if you are working in Mauritius, it's Mauritian source income. And even if the money is not remitted, you're taxed. in their case, there will be no tax except if they remit. This is the change. If they remit, but they will be able to use their debit card, their credit card, without this entering this definition of remittance. So it's a very good move to attract in those who will be interested with the regime. Now, your question, is it possible, is there a risk that these persons, if they are representing companies outside, and you know that in the treaty that we've signed, there is this agency PE, and you become, your company, let's say they are working for a foreign company, and let's say they have the power of attorney to represent the company in Mauritius, to conclude contracts on behalf of the Mauritius, even if they don't sign the contract, but they negotiate and they make recommendations which are accepted by their company. So their company will be deemed, but this will be the extreme situations where they are as representing, they have the power of attorney to represent their company in Mauritius. But if they are just like helping their company without this having a power of attorney, I don't think there will be any issue of having the risk will be completely disappear.
That's comforting to know, because that's one of the things I was most concerned about. Gordon, coming back to you, we're talking about the broader picture, and we've had conversations about this before. So there's all been these measures to attract even more skilled labor in Mauritius. It's easier to purchase property now. Spouses of occupational permit holders can work. The threshold, I believe, for the occupational permit have been reduced for certain specific areas. So it's all well and good to have all these measures to attract skilled talent in Mauritius. But what about retention? Do we have enough? Is our ecosystem enough to retain? I struggle myself. I've been back in Mauritius for 8 years now, and people are always shocked when I say that one of the things I miss the most is Waitrose. I mean, we do have a small Waitrose now, but do we have a broader, we're not talking about tax here, we're talking about a broader picture. Do we have enough to attract and retain skilled talent in Mauritius?
Yeah, thank you, Joanne. I mean, I think for everyone who knows me, I'm pretty outspoken on this. And it's funny, I was reading an article yesterday, and we talk about the potential for Mauritius. I was reading an article yesterday that between 2017 and 2020, that's a very short period of time, South Africa's lost $8,600 millionaires. And I think the question is, how many of those have actually moved to Mauritius? I did send through, I was reading another article a couple of months back, which I sent through to my colleagues at the EDB. And unfortunately, most South Africans are typically looking at Australia, the UK, Canada, the US, and Portugal. Portugal's very, very popular. And sadly, Mauritius wasn't even in the top 10. So I think there's an opportunity here that we're missing out on. When we talk about foreign skilled capital, you've correctly pointed out that there's two issues that we need to deal with. And that's attracting, and then probably in capitals and in bold and underlined, and retaining. And it's important to remember that Mauritius is competing against other countries to attract and retain those particular individuals. So, with regards to Mauritius, in the past, South Africans would probably look past the high cost of living because the personal tax rate was relatively low, 15%. But when you now throw in the 25% solidarity levy, plus the 3 plus 6% CSG, I don't think Mauritius can qualify as a low tax jurisdiction anymore. It's common cause that the benefits of increasing and retaining immigrants include you're increasing the size of the active working population. As a result, you'll be contributing to an increase in tax revenue, which I'm sure will make Mario happy, an increase in aggregate demand, You know, obviously, the more people here, the more disposable wealth, the more people can shop. And there's an increase in skills and knowledge sharing. So there is definitely a benefit to the Mauritius economy to attract and retain. I don't believe that there's any material issues when it comes to attracting skilled expats to Mauritius. And, you know, the fact that 36,110 OP and RPs, which were made up of the professional, the self-employed, the investor, and the retired, the fact that that number has been issued over the last 15 years, I think the facts speak for themselves. You know, I think that's testament to the fact that there isn't an issue in attracting. You know, the additional measures that have been announced over the last 2 years are great. And again, I have to applaud the EDB for the initiatives that they have shown. However, at the same time, you know, to attract and retain, there needs to be greater certainty. And the perception is that there are mixed signals being sent. And when I speak, I need to say this right in front. What I'm about to say are not necessarily my views, but, you know, there are comments that have been mentioned to me by other members of the expat community. So whilst at first glance, you know, it may appear that there's a push on the part of the government to increase the expat population, and we see it mentioned in the blueprint, and we hear it. I think we heard it in this year's budget speech, and we heard it in last year's budget speech. When we critically analyze what is being offered, it's not always as attractive as it may seem. Now, remember, someone who's about to up and leave and go to another country is not just going to take things on face value. They're going to do their homework. We're looking at attracting the high net worth individual. That's someone who is not just going to take a chance. They're going to do their homework, and they're going to do it properly. So, you know, let's have a look at the first one, which was the change in the minimum age for dependents. So the maximum age of 24 to qualify as a dependent is gone. And instead, they've replaced it with the definition, and I'm just going to read it if you don't mind. You know, it's a wholly dependent child who is unmarried and who is not engaged in any gainful activity. Okay, so at face value, that looks great. Someone looks at it and goes, excellent, my dependent child can stay with me. There's no cap at 24 anymore. But I think we got to start off. What is the starting point here is that most families want to stay connected and, you know, united. You want your family around you. Now, if we take a child who has now, let's say they've come out of university and they now want to start working, well, they need to go and find a job at a minimum of 60,000 rupees. Otherwise, so that they can apply for that OP. Otherwise, they're going to have to leave the island. So now you've just broken up the family structure. So that's going to count against Mauritius when people are looking at that from a strategic perspective. Allowing spouses to work. Well, we saw it last year and then it disappeared, and it's come back in this year. But, you know, when we saw it in the budget speech, geez, it looked really good. But then when we start seeing the fine wording, you know, the spouse of an OP may on application. Well, that doesn't help, because what if the EDB turns it down? So again, there's no certainty. And then my personal favorite, sorry, I had to laugh, the reduction in the minimum price to qualify for a residency permit with regards to property. So yes, you know, the property price has come down from $500,000 to $375,000, but that doesn't actually mean the physical property prices have come down. You know, property prices in IRS, RES, PDSs, they're still very expensive, especially when you compare them to an equivalent property which is available to citizens only. And, you know, typically the average size home is retailing, and I'm talking about for an expat, is typically retailing at around about 30 million plus. That's a lot of money. And most expats who live in Mauritius cannot afford that amount for a property. You know, just yesterday I received an email asking if I would be interested in buying a property. There's some development taking place on the West Coast. And I looked at this and I thought, you know, how? When you're talking about 160 square meters on a 480 square meter plot, and the starting price is 19 million rupees, it just doesn't make sense. So I think what I want to say is that the data is showing us is that there is a big problem in retaining expats. Attracting, I don't think there's an issue. Retaining is the issue. You know, I mentioned earlier that in the last 15 years, there was the 36,110 OPs and RPs. But what's frightening to see is that there's only 6,400 that are still active, which means that in the relatively short period of time of 15 years, you know, you were talking earlier about companies that tax holidays need to be of a certain amount of time. Remember, you're asking people to move away from their country to a new country. We've got to look strategic. We've got to look long term. So 15 years to me is a short period of time. And in that 15 years, 29,710 expatriates have elected not to remain. That translates into a retention policy or a retention percentage of only 17.7%. And that's just under 2,000 individuals who are leaving on an annual basis. You know, there's many reasons why people do not remain, but I think the consequences of them not staying have been mentioned earlier. You know, we talked about additional tax revenue, etc. You know, if we're going to compare Mauritius to other equivalent jurisdictions, Singapore, 37% expat population, New Zealand, 22, Luxembourg, 47, Dubai, 88.5. Mauritius is coming in at 0.5%. And that's, to get to that 0.5%, I took the 6,400 and divided it by 1.2 million, which is the population. So, you know, if the intention is to retain expats in Mauritius, then the country has to offer real incentives. There's got to be a hook that keeps people here. You know, as an example, you know, increasing the residency or the PR from 10 years to 20 years. Yeah, that's convenient because it means I don't have to trek down to Port Louis every 3 years or whatever. But just because someone is allowed to stay here for 20 years doesn't mean that they're going to actually stay here for 20 years. If there's no hook, if there's no reason for them to stay. So it's a long-winded way. So I'm going to say, Joanne, to answer your original question as to whether the current framework is enough to retain the skilled labor, most of the feedback that I have received from the expatriate community is that people feel that what has been issued are, again, just token gestures, and that the real concerns have been overlooked. You know, the issues that I hear and that get mentioned to me on a continuous basis is the limited ability to acquire citizenship. I've got my wife's cousin moved to Australia after I moved to Mauritius.
And she's got her.
She's an Australian citizen. Then there's the restriction on the acquisition of residential property outside of the property zones. Now, I do understand the concerns, and I wouldn't open this up to OPs and RPs, but for permanent residents, at least in New Zealand, if you're a permanent resident, you can buy property there. They've blocked it for others, but if you're a permanent resident, you can buy. That's a hook. Discrimination in school fees. I don't know if people are aware that non-citizens, we pay significantly higher school fees to use exactly the same school as citizens. And then I have to throw in my own personal gripe. This one is mine. Is that as a resident, as a permanent resident, someone who's been here for in excess of 5 years, why is it that every time I return to Mauritius, that I have to fill in the same form that the tourists have to fill in? I totally get it that I have to fill in the medical form. That's everyone fills that in. I understand that. Surely my details have got to be on the system. You know, in 2019, I passed through that airport 12 times, but I've still got to fill in the same form. So to answer your question, no, I don't believe that there are sufficient incentives to attract and retain individuals. Attract, no problem. Retain, there's a big problem.
Yes, and I fully agree with you, Gordon. And I think that what happened with the solidarity levy last year didn't help either. I know many people who, that wasn't the only reason why they choose to leave, but it certainly weighed in the balance significantly. So I think with this charged note, I'll move on to a more technical topic to bring down the temperature a little bit. So I wanted to talk about my personal pet subject, which is Section 75, so the arm's length principle. In the budget speech, the minister announced that the Section 75 will be clarified, as he put it, to ensure there was no ring fencing with GBCs. Now, I have to admit, I was slightly surprised when that came out in the budget speech, because I never thought that there was any ring fencing. For me, Section 75 was always perfectly fine, and it made sense because it applied only to business and income generating activity carried out in Mauritius. And that made complete sense. If you're choosing to carry out your business wholly outside Mauritius, then where does the arm's length principle come in for the MRA? Now, the amendment that has been made is 2 words, seemingly innocuous words, have been added. So in addition to in Mauritius, we've now added all from Mauritius. And to me, that has raised more questions than given answers. I'll give you an example, Mario. So if you have a company that is incorporated in Mauritius, tax resident in Mauritius, but carries out all its activities outside Mauritius, so for example, through a factory in Mozambique, for example. So does that mean that, one, the MRA, even though it is incorporated in Mauritius but carries out all its activities outside Mauritius, the MRA will now have the power to adjust the pricing? Could that lead to double economic taxation? So upward adjustment by the MRA, but no corresponding adjustment on the other side? And are we confusing tax residents on one side and where the business is being carried out on the other? So Mario, I'd just like to understand a little bit more about this, because I'm genuinely confused.
Joanne, very, very good, very interesting question. I know this is your area, transfer pricing. I agree with you that the basic principle should be profits are taxed where economic activities generating the profits are performed, but also where value is created. And this is where the amendment brought by Section 75 is, in fact, I would say probably I will disappoint you, is very pertinent. Is a necessary clarification in a post-BEPS world, where the concept of value creation has shed light on the principle, on the proper application of the arm's length principle. So you know that the notion of value creation reframes the interpretation and application of the arm's length principle that is embedded in Articles 7 and 9 of our treaties, that is based on the OECD model. Now, I would say that the pricing of intra-group transaction should not only reflect where transactions are performed, but also the relative contributions of each party to the international creation of value. And this can effectively be done both in and from a particular tax jurisdiction. And the clarification of the law was necessary in order to ensure that Section 75 would apply, and indeed apply, whether an entity is carrying on its business or other income-earning activity in Mauritius or from Mauritius. You know, when we were reviewed by the OECD and the EU, one of the pertinent questions that was asked to Mauritius was, what about your anti-avoidance provision? The EU was more tough on this. And they, in fact, had reviewed our GAR, General Anti-Avoidance Provision. The OECD has asked about our arm's length principle. And in the BEPS Action 8 and 10, they have taken this into consideration. And I know that everybody in Mauritius, even when the budget was the budget speech, everybody said it's true that the arm's length principle applied to everyone, even to global business companies, and that the Section 75 falls within the part of the income tax legislation dealing with international aspects of taxation. The case that went to the ARC was a standalone case, exceptional case. There was no substance in Mauritius. And we have been, in order to have a clean jurisdiction, we've said that we want Mauritius to become a country of substance, and where we don't have shell companies, we have companies that have substance, that are doing really business in or from Mauritius. So we should not send a signal that we are not complying with all what has been said, the commitments that has been taken by Mauritius. And I can assure you that if, I think the danger, what has been said, that this, in fact, in our mind and in the mind of many people, the arm's length principle was there and was applicable not only to non-GBL, but to GBL. But what I call it, unintended consequences that this ruling can have. People can think that arm's length principle no longer applies to global business companies. And I can assure you that if we have the MRA, we'll never go back to because the Income Tax Act in 1995. It's just you are just clarifying. And I would say that, I don't know, maybe for the attention, for the comprehension of those participating at the LP, I will make a reference to paragraph 151 on functional analysis from transfer pricing guideline. Also, we don't have a transfer pricing guideline, but we base ourselves on best practices. We are not bound by the OECD guidelines or the UN, but we follow the best practices. And what is said in that section? In transactions between two independent enterprises, compensation usually will reflect the function that an enterprise performs, taking into account asset use, risk assured. Therefore, in delineating the control transaction, I will not read that, but in particular, it is said it is important to understand how value is generated by the group as a whole, the interdependencies of the functions performed by associated enterprise with the rest of the group, and the contribution that the associated enterprise make to that value creation. So I think it was an important, necessary clarification. And now, if you tell me that the MRA has never, even if there has been a change, we don't have this authority to go back, because there is we can make assessment for beyond, we can't make assessment beyond 4 years. And also, when it comes to the anti-avoidance provision, the onus is on us. When we go in court, let's say we take section 90, we have to demonstrate that there was it's not even principal purpose, but I think in section 90, it is mentioned, if the sole or dominant purpose was to avoid paying tax. Yes. I don't know if I've answered your questions.
Well, we just agree to disagree, but I'm sure we'll perhaps meet at the ARC on another occasion. But I'll come back to you, Mario. But first, I want to ask you, Fazil. So Mario said we were not going to go back to 1995, but we may go back for 4 years. So retroactivity. There have been some concerns raised about, well, initially the entry into force of this provision was, I think, year of assessment 2022, 2023. This is now gone. So it's when the Finance Act was passed, which was the 5th of August. On the other hand, you have section 75(1)(a) that says that it's just a clarification. So it's deemed to be enforced since the beginning of the Act. In your view, is that a retroactive provision? Not from 1995, but at least 4 years ago. Can the MRA raise assessments on activities carried out from 4 years ago, because they take the view that it is not in Mauritius, but from Mauritius?
Okay, thanks, Joanne, for that. I mean, first of all, it's comforting to hear that the MRA will not go back to 1995. But let me explain the point here, perhaps for those who are not familiar with this section, to explain what is the confusion and how it appears that there may be some conflicting messages within the same piece of amendment. So initially in the finance bill, it was stated that this amendment to change the arm's length test to include transactions or income from Mauritius as well as in Mauritius. Now, the amendment shall come into operation, Joanne, as you said, in respect of the year of assessment commencing July 2022 and for subsequent years. But then the finance bill also contained a paragraph which said that for the avoidance of doubt, very interesting language, that the test shall also apply to activities since the commencement of the Act, and the Act being the Income Tax Act 1995, of course. So two potential commencement dates. And it's interesting that this point was raised in the parliamentary debates, not once, but twice, as we can read in Hansard. But then when the Finance Act came out and we reading it, the reference to 2022 was gone. So you deem that the commencement date or entry into force is the date of when the Act receives President's assent, which was the 5th of August. However, the other interesting paragraph, which for the avoidance of doubt, and certainly there's no doubt by then, remained. So and again stated that the commencement would be when the commencement of the Income Tax Act. Now, clearly there is confusion within the industry, within practitioners, by the business community and taxpayers that the amendment can apply from the commencement of the Act. And in the worst case scenario, which thankfully now it appears has been clarified, that the amendment could have retroactive effect, meaning that it operates as of a time that was prior to its enactment. Now, that would seem grossly unfair. Now, let me come to the point as to, and then let's assume that it's not going to be retroactive going all the way back to 1995, but could it be retroactive going back 3 or 4 years being the statutory limitation? Even then, I think it would be grossly unfair and unreasonable for an amendment to take place in 2021 and to say that it applied for transactions that took place in the past, just because the cases or the years of assessment are still open or under audit. And it's very much a concern for the industry. And it's funny because it touches on the point that I mentioned earlier on when I was talking about the 3 things that were attractive in our tax system. And one of them was the certainty, the comfort that investors had. Suddenly, we're coming up with legislation which affects past transactions. And just because the year is still technically open, an investor or a taxpayer has that uncertainty sort of hanging over his head. And this is not the type of signal that we want to send to the business community out there, let's face it. I mean, no one wants to see retroactive changes or retroactive law amendments that open up issues that otherwise everyone think are closed. So, Mario, you mentioned the Baylines case. I think there is, the industry feels that part of this amendment has been brought in because of that case, and the fact that MRA wants to, the authorities want to clarify that the test now applies to GBCs or especially to activities from Mauritius. We'll disagree on that as well. But I think the most important thing here is that ultimately, we need our tax system to be something that gives comfort to investors. And this is a very typical example of changes or a change that is brought in that does the complete opposite. And for me, in an ideal world, we will not apply this retroactively. okay, the change has been brought in, we agree or disagree with it, but at least it applies prospectively. But it sets a bad precedent. You know, if a law can be brought in, amendment can be brought in, and suddenly we say, oh, it applies retroactively, we can expect more in the future. And who knows, today we're saying, okay, we'll go back 3 or 4 years. In the future, maybe we'll go back more than that. So it sets completely the wrong signal. And I would like to hear both Mario's view on that, and also Gordon's from the point of view of the investor community, the taxpayer community.
Yes, and I fully agree, and I'd be lying if I didn't say I wasn't looking into potential constitutional challenges. So, I mean, as you said, Fazil, the change is now there, so it's okay for it to be prospective, but I do have an issue with the retroactive effect, and just by putting the words for the avoidance of doubt doesn't mean that it is for the avoidance of doubt. But I think, if we go back a step, I think both of you mentioned that the need for certainty, and Mario, you mentioned we don't have TP regulations, and that's fine. But given the number of cases before the ARC at the moment on Section 75, isn't it perhaps time to have some sort of statement of practice or guidance on Section 75 to give people a bit more clarity on in what situations it will apply and in what situations it won't? I think it would be really helpful for taxpayers.
You're right, because I don't see the MRA going back to cases which were similar to the one which we lost. This is definitely not the purpose of that clarification. That is to go back to what has been done, or to reopen the case of which we lost before there. And I know that in cases where there were no substance and business were not being done in Mauritius, I don't see any possibility for MRA to open or to go back because of these changes. But what we have to probably make clear is that our global business companies that are benefiting from the preferential tax regime, they have the obligation to comply with the substantial activities requirements, with the international standard, and then they can't say that they are not bound by Section 75. This was my point.
I fully agree with you. I think now in the new post-abolition of foreign tax credit regime, there wouldn't be a question of the applicability, because they have to carry out their SIGA in Mauritius in order to claim the partial exemption. I think we're more worried about the past. Gordon, some final words on transfer pricing, if any, not from a technical perspective, but more from a I guess from a client perspective in terms of certainty.
No, I think Fazil's covered it perfectly. I mean, ultimately what clients are looking for is certainty, and decisions are based on what the law states at that particular time. But if there's now this perception that, well, it might state this particular year, but the following year, the Finance Act may bring in another piece of legislation that says, no, we want to backdate it. It does send out the wrong message. There has to be certainty. There has to be clarity, so that clients can make strategic decisions in all comfort.
Thank you. I think there's only 17 minutes left, so I will go through some of the FAQs. I think there are many questions for you, Mario, so you'll be happy about that. So let me look at some of them. Some of the questions have nothing to do with what we discussed, but I think it would be useful to get some clarity on it. Does an authorized company have to withhold TDS on payments made to non-residents and residents? And if so, what would be the rationale?
Yeah,
Mario.
Good question. So, authorized company, I don't know this term. I know they are licensed, but this term is not in the Income Tax Act. We treat all companies that are non-resident in the same way. Now, when you talk about authorized company, they are incorporated in Mauritius. So if they demonstrate to our satisfaction that they are not centrally managed and controlled in Mauritius, they will be treated as a non-resident company. And if they are making payments to non-resident, I don't think that we have an obligation. We don't ask non-resident companies paying to non-resident to do TDS. Normally TDS or companies in Mauritius, they are paying to Mauritian companies, because TDS is what? Is to allow us to, it's an advance payment for taxpayers in Mauritius. So if the non-residents are getting paid by non-resident companies, so there is no tax in Mauritius. So there is no, this is not, there will not be no purpose for withholding for applying the TDS.
Yes, maybe we might make some representation. I think the question comes from the wording of the legislation, creates some confusion because it just talks about a company making a payment as opposed to a resident company. But I agree with you. We've also got a question on whether, Mario, you have any indication on when we might receive that famous statement of practice.
I think there's been representations from the stakeholders, there have been discussions, and I think it has reached a well-advanced stage, and it will be coming soon, but we want to make sure that we get things right and that we address what should be addressed and put Mauritius in the same level playing field as other jurisdictions, giving the same product.
Is it likely to be this year then?
Very soon, very soon.
I was hoping for this afternoon. Yeah, I think on that, Joanne, I mean, it is very, very important. And shame poor Mario is getting the brunt of this, being the MRA representative. But I think it is really important for the MRA to understand that this has materially affected Mauritius's reputation. And we're all fielding calls by, business introducers, attorneys, accountants from different jurisdictions, even clients going, what is happening? We need certainty. And for the longer it takes for this SOP to come out, that is lost business. And we also then run the risk that clients will go, well, or these financial intermediaries will go, well, look, we don't know what's happening in Mauritius. Let's look at other jurisdictions. And we're opening the doors to our competitors and we need to close those doors as quickly as possible.
Yes, and I can say that from experience. I can see particularly in the Channel Islands, they're circling around like sharks because they aggressively market their jurisdictions for Africa as well. So yes, we need to get that.
Now, this you can be certain that while we are very strict on respecting the conditions for what commitment Mauritius has done, but at the same time, we are concerned about the competitiveness of Mauritius and having a level playing field. Even at the level of the inclusive framework, we make sure that we are not treated in different way than other jurisdictions, and that we lose business in, we are at a disadvantage. We should not be at a disadvantage.
Yes, I agree.
I think on that, John, if I can add, you mentioned, Mario, earlier on that the OECD had raised questions with regard to foundations, and we anticipated that they would be raising similar questions on trust, and we've been proactive in making the changes to our law. I think there's a balance that needs to be struck between how proactive we are complying with the requests and the demands of the OECD and the EU, and appreciating the commerciality of the impact of these amendments and changes in law on business. And I think sometimes maybe we are a bit too prudent or too proactive in the complying bit without really thinking about what is the impact, especially if there's laws or changes like that without prior communication. It has, it can have a damaging impact on the community. I don't know
if I may, maybe having got a lot, I've got different views on this. I think that being privileged to represent Mauritius at the level of the inclusive framework, we have always at the same time trying to comply with international standard, but seeing that also there is a level playing field. And I think Mauritius has done a lot in this, that those jurisdictions that they have to there should be. We have always been pushing for level playing field, and in terms of trust and foundation, it's a question of how we have this was in our law. As other countries, they have different law. So as I said, that we need to reflect on this and fix it and have the same, probably same type of legislation that others have. But in the meantime, I think that we have heard the representations and we are looking for quick solution, interim solution, which probably will mitigate a lot of the risks that you have raised or the concern that you've raised.
Thank you. I think I'll take two more questions before final words. Again, this has nothing to do with what we discussed, but I think it's quite important for the global business industry to have your views on it, Mario. We've all heard about the Sexum case, where it was held that the directors of a company are responsible for the debts of that company. Now, I can't remember which section it was, section 81 maybe, that talks about agents of a company, and it does talk about principal officer. As you know, Mario, the vast majority of GBCs have 2 resident directors being from the MCs. I think they're all concerned about the impact on that case on their personal liability as agents. My personal view is that it should be the principal officer. You should look at, that there was that case where you're looking at the sole shareholder, sole director. It made perfect sense for that to pierce the corporate veil in that sense. But when you've got directors who are from the MCs, who are in effect non-executive directors, is it fair to pierce the corporate veil and put personal liability of the company on them?
This is an area where I will be very cautious in the sense that there are cases that went to the court. And I think that everybody, MRA and the stakeholders also, should probably rely on the interpretation that has been given by the court, the private counsel. There was a case, and I think that we, as well as MRA, and how we should apply the law as it has been interpreted. And when you mention that some directors may be irresponsible, I don't know if this case fit in what maybe those cases were completely different from the case which went to you are in a better position. Probably you are better qualified to interpret what has been said by the court. And as far as I am concerned, we are bound to follow the principle which has been laid down and the interpretation that has been given by the court.
Thank you. Last question. I think I will take a practical question, because people, we talk about technical aspect, but I think in the day-to-day running, it's quite important as well. Someone has asked that has said that the MRA has recently set up a new online system for renewal of TRC, but this is taking a very long time for renewal, which is not very favorable for companies which need TRC renewed. Do you know why the delay? What might cause the delay in renewing? Are you aware that there's a delay?
No, probably. What we have changed is that now they do it online and everything. It was formerly it was a mix of manual and online system. Now it has got a complete different setup. I know that there has been some discussions between the FSC and the MRA, and there were some issues. I know MRA is looking into it. Probably these were the issues that caused certain delays. But what I have heard that I'm not personally responsible for TRC, but I know that they are looking into. And if there is any delays, I'm going to try to see if we can solve any issue, because there should not be, in the past, we have not, if it is a question of this new system which are causing delay, we have to fix it.
If I can come to Mario's defense, we haven't had any delays.
Okay, great. I think we've run out of time for questions. So to the extent your questions haven't been answered, Fazil, could you give an email address that they can send them to?
Yes, we'll send an email address to
participants.
To the participants.
Thank you. So we've got 6 minutes on the clock. Final words from each one of you. Fazil, I'll start with you.
Okay, thanks, Joanne. I'll echo some of the concerns that we talked about earlier. And it's interesting to see that there are the attractiveness of the jurisdiction from a fiscal perspective needs, I mean, we used the word revamping earlier on, but I think there's work that needs to be done in a more holistic way to look at how the jurisdiction can retain its attractiveness and retain all the great features that it used to have, especially given the very difficult context, international context and landscape that we're operating in. And we are aware of the changes from the OECD. I mean, there are some rules and some parameters that we won't be able to, to ignore. But within those parameters, we have to define a system that is both attractive and sustainable. And that takes a bit of time. It's not going to be, 2 months before the budget that we're going to run around and look for ideas and representations. It takes much longer. And I think we have to take to reflect on that, because if we keep adding piecemeal changes, then we're failing to see to have a vision for the jurisdiction. And as the competition from other jurisdictions increases, we may find ourselves in an unwanted positions in a few years down the line. So my wish is for us to be able to think about the attractiveness of the Mauritian tax landscape in a wider approach, and hopefully come up with proposals that can take us, over the long term, or medium to long term, in a more favorable position that we find ourselves in today.
Thank you. Arya?
Yeah, I think Fazil is right. He has been talking about the competitiveness and the necessity for us to be able to compete fairly with other countries. We at the MRA, we are normally concerned with making sure that our preferential tax regimes complied with international standard. Maybe these are our core, in fact, international tax law. But I will make an appeal to the stakeholders, because we also look at, we compare ourselves with other countries, and why are they, let's say, complying with the region, at the same time giving more benefits than Mauritius. So if the stakeholders, know about certain jurisdictions which have certain system which are probably more attractive and at the same time complying with international standard, let us know. We have a forum, the technical working group, where we can discuss, and it can be we can be informed well in advance, not just before the budget, so that we can work on a certain regime which, when you compare our regime compared with others, they are more competitive. So I think, but as far as we are concerned, as I said, we have to see to it that we complied with international standards.
Thank you, Gordon.
Thanks, Joanne. I think to start off with, I have to say, as a foreigner living in Mauritius, that the country has enormous potential. It really does, and it offers a lot. And we've covered all the soft factors, we've covered all the hard factors. But I kind of feel that over the last 2 years, the changes that have been made has not been well accepted from an international perspective, and I think we've lost out on an opportunity. Especially as I talked earlier about, the amount of millionaires, dollar millionaires who've left South Africa, great entrepreneurs, high net worth individuals. And I think if there had been perhaps more opportunities offered, that they would have relocated here, because it is a lot more convenient. It's a simple 4-hour flight away, as opposed to them having to leave elsewhere. We've talked earlier about recommendations and providing recommendations before the time. I've had the privilege of sitting on the FSC task force. I represent Mauritius Finance, and I know that I have invested many, many hours in putting forward recommendations and suggestions, which unfortunately just don't seem to be listened to. And, you know, I think we're going back 2 years where the various FSC task forces, I think we put together something like 54 recommendations, and I think only about 4 or 5 were incorporated. Please don't quote me on those numbers, but it's in that bracket. And I think, you know, this is where perhaps, and one of the things that really impressed me when I moved to Mauritius 5 years ago, it was strange to me, is when there was this whole change from GBC2s to authorized companies. And I remember going to the Flying Dodo at Bagatelle, and Mario, I think it might even have been you, where it was, the MRA was sitting talking to the private sector going and asking for suggestions. And I sat there and I could not believe this, because never in my life had I ever heard of the South African Revenue Services openly sitting down with the private sector and asking for their input. But it seems to have dried up a little bit since then. And maybe that's something that we can incorporate again, because I think if you have that collective knowledge and shared knowledge, and we're running out of time, so I'm going to say goodbye.
That's okay. I don't think it was suddenly cut off, but yeah, I think you can add a few more words.
I was just going to say, please, certainty and stop sending mixed signals.
Thank you. Well, thank you very much for your time. I know you all have very busy lives, so thank you for making the time to speak to our audience today. I think we had more than 300 participants, so thank you for your time. That's a wrap for today. If you have any questions, you will probably receive an email from the host. You can drop in a question anytime. We were very happy to be hosting this webinar today. Thanks again.